warm up.
I got some moves right now. I'm going to call that my Rein It In dance. Ladies and gentlemen, welcome to episode 22 of Rein It In, where I got 4 sticky notes, but they're big topics of conversation. Number 1, we're talking about the Bank of Canada and their rate decision. Number 2, we are talking about the price of oil, Patrick's predictions on the price of oil, and the 5-year bond yields. Number 3, we're talking about unemployment by province and where it's all trending. Number 4, we're talking about price predictions. And since Patrick is so good at price predictions, we're going to find out what he thinks. So get ready for a great show.
JG, we got to add a couple more points. Actually, we want to talk a little bit about China, what's going on in China, and we're going to fold in a little bit of technology because guess what? Technology is going to change the game.
Adding it now.
Listen, folks, we need you to subscribe, to follow. JG and I work hard to give you great content. So please subscribe, share, comment. Tell us what you like, even tell us what you don't like. Those comments help us get the algorithms, but it also tells us what we need to give you that we're perhaps missing. Let us know.
Looking forward to it. All right, Patrick, let's jump in. And I think the big news, I think we got to start with this, is the Bank of Canada and their rate decision. Pause. I literally felt the real estate world just go yesterday, because for us, we're shooting this on September 7th. This happened on September 6th. I don't know how you felt about it, Patrick, but I just felt a sigh of relief. I actually got text messages from investors I work with that were like, oh, good, we finally got a bit of a break here. So very, very good news for the real estate market. And I think people are going to see throughout this episode why the Bank of Canada got to that decision of pausing. We're going to show some interesting data, but your thoughts on it for now, Patrick?
Well, I think you nailed it. I mean, it was a national sigh of relief. There was a lot of tension leading up to that announcement. People were very, very nervous and afraid that if they bumped it another quarter, I mean, gosh, it's only a quarter, but it's already on top of the fastest and the greatest increase in interest rates over, I think, probably in history of Canada anyways, of what the Bank of Canada has been doing. So it was a big sigh of relief. And I think it's going to just actually change the velocity or the market in a way, in a positive way, at least take the edge off it a little bit. Things can calm down.
Yeah. When is the next rate decision, Patrick?
That's a great question. I want to say October, and we'll see what they do in October. But ultimately, it's already baked in. I mean, listen, we don't know what they're going to do. I'm not going to make any predictions because I actually don't think the Bank of Canada knows what they're going to do. Our federal government doesn't know what they're going to do. This is read and react. We don't know what the decision is going to be.
October 25th is the next rate decision. That's when it's all going to go down. So essentially gives us like a good 6 weeks now, Patrick. I'm very curious to see what the market's going to do. And I think that we were talking with some partners that we have over at DI Vault. By the way, folks, if you haven't checked out our launch of the DI Vault platform, an artificially intelligent platform, you have got to go to di-vault.ca, di-vault.ca. Go check that out. But we were talking about with our partners over there, Patrick, and they were expecting, if we would have got a rate hike, they were expecting some serious flooding of sellers on the market. Now that we haven't had a rate hike, it's going to be interesting to see what transpires. But I definitely have just sensed an incredible relief in the market to give us a bit of runway to see what we can do with this market. And in this case, our runway is 6 weeks.
Let's qualify a couple things here, JG, because, you know, when we're talking about our partners within DI Vault, within that technology, which is being a game changer for investors in terms of finding real estate, what he's saying is if it would have gone up 0.25%, there would have been a flood of real estate onto the market. Now, that's not because sellers want to sell. It is now becoming about distressed sales. So let's be clear about that. It's not like all of a sudden,
oh, rates are up 0.25%, let's sell.
It's no, rates are up 0.25%. We have no choice. We cannot take on more payments. There's going to be more distressed sellers into the market. So I just want to make sure that we're qualifying that. You know, I was speaking in Calgary to a couple hundred realtors just yesterday, and they're really struggling with listings. And we can talk about that when we talk about what's going on in Alberta. But ultimately, people with these rates, they're not wanting to sell. So listings are not coming from people who want to sell. It's actually coming from people who need to sell.
It's now or never.
Okay, sell it all.
And whether that's a job loss, a job transfer, some reason, and primarily distressed, I've got to get from underneath these payments. I can't handle them anymore.
You know what's interesting about the rate decision, Patrick, and just where the market's at specifically now. I operate in Ontario, specifically outside the GTA, and that kind of those B markets like Aurelia and Lindsay and Peterborough and so on and so forth. What's interesting though, Patrick, is that man, I haven't had it. I mean, it's been so busy this summer, and typically you and I slow down in the summer. We take a little bit of time off. And even though I've done a little bit of that, it's been so busy because there's been so many deal-making opportunities, things I haven't seen in the market in years and years and years. Way before COVID, I hadn't seen these kinds of opportunities in the market. Opportunities to buy at a great price. Patrick, I have a property under contract right now for $350,000. I never thought I would say the words 300 and something ever again. You know what I mean? So interesting that there's definitely some opportunities that are really showing up. If you're a buyer and you're in the market and you have a long-term outlook, and when I say long-term, I mean 5, 8, 10 plus years, definitely some interesting buying opportunities. I know it's really busy on my desk right now in terms of the opportunities coming across, but people open to creativity as well. People open to partnerships. People open to vendor takebacks. People open to agreements for sale. These were not possible just a couple of years ago. It's now possible. Patrick and I were telling everyone, Patrick, we were yelling it from the rooftop. Be careful what you buy. Be careful. We're at the top of a market. And we were saying that. And now I'm saying the opposite. I'm saying if you want to get into the market, my gosh, we know. I'm not saying we're at the bottom of the market. That's not what I'm saying. But I'm saying we're off the peak for sure. And it's definitely an interesting buying opportunity. At least I am moving on that. And I'm using platforms like the DI Vault to find those deals, by the way. That's where I find the deals.
Okay, so let's qualify a couple things. You know, first off, you're in the trenches given what you do with Vista Properties and property management, and you as a developer. I know you've got an injury because you haven't worked for a long time. Let's face it, you just blew a tube. That aside, so let's talk about some things here, JG. You're in the trenches. You're actually in the business of investing in real estate. That's your game. I've noticed how slow it is because a lot of investors hope to be investors are out. They're sitting on the sidelines. They don't even know what to do. So my question is for you. I agree. Distressed sales. So we're seeing agreements for sale. We're seeing a huge uptick in rent to own because there's some opportunities there. But I'm curious for you when you're looking at how does an investor get into this market, get into cash flowing properties? So the deals that are coming across your desk that you're either saying yes to or no to, are they detached? Are they condos? Are they townhouses, fourplexes, sixplexes? What kind of deals are you actually seeing come across your desk?
Great question. So first and foremost, it's kind of all of the above. Here where the markets I operate in, there's just not a lot of condo sales. I'm not in that business. So I don't see a lot of condos because I don't buy those usually. Yeah. So it's really detached. It's duplexes, it's triplexes, it's small multifamily, like less than 5 units. You know, like for example, I got one person came to me recently and they have 21 units. They have 2 8plexes and a 5plex. And this thing's been underperforming for some time. And now the mortgage rates are coming and he sees the future. He's like, holy crap, I'm going to have to renew at a much higher rate in a year or two. Maybe I should get out from under this thing right now. And there's quite a bit of equity in this portfolio, but there's 21 doors, Patrick. So to answer your question, it's all the different types of properties. And I do want to qualify one thing, that it's not just distressed. When we say the words distressed, people have this vision that it's, you know, people can't afford their mortgage and they're at the end of their rope and it's like a real distressed situation. It's not, in most cases, it's not that I'm dealing with. It's just people that are saying, listen, I see where this is going and I want to get out of the market now for whatever reason. So they're kind of pre-distressed, if you will. They know they might get into distress in the next 2-3 years and they want to get out before it. I am seeing some of that.
I'm in distress. I can handle this. Have a nice day.
I'm really glad you brought that up because that in in fact, is what a sophisticated investor will often do. They'll look into the future, they'll look into their portfolio, and to your point, it's not distressed as in desperate, I'm sure, and I know there are those out there, but some of it is just risk mitigation given where people are with their portfolio. These are actually sophisticated moves to mitigate against future risk or a future downside. Some are just taking cash off the table because they want to be more liquid. So they're looking at the market going, this is even going to get softer and or there's going to be even more opportunities. So liquidity is the name of the game in that regard, and especially when it comes to financing these days, with OSFI threatening the new rule changes and some of the changes that have been made, financing is more difficult, more money needs to be put down. These are all things that we have to take into consideration. And that's actually just a savvy move, by the way. So to your point, it's not necessarily distressed in the context of desperate, but often these are good moves for investors to make.
Yeah, I don't want to beat this to this horse too much, but I must say, Patrick, there's two things, and I work with a lot of real estate investors that don't have these two things. And there's two things you need right now to take advantage of this marketplace. And too many investors don't have these two tools. And there's really two major tools in your toolbox here. If you have these, you can take advantage of a market like this. If you don't have these, you're sitting on the sidelines asking yourself, why am I not getting the deals? Where's the cash flow? How come I can't get in this market? And you're kind of sulking yourself to sleep every night. So the two tools are this. Number one is the new AI tools and we've released one of them, this di-vault.ca. Go check it out, DI Vault, which is a platform that's artificially intelligent. This helps you find these kinds of deals. Yeah. It's incredible. And that's one of the tools. Leveraging today's most cutting edge technology is a massive tool every investor needs to use. That's part one. And part two is we got to go back old school and we got to say you need the knowledge. Patrick, the more knowledge you have, the less time and money you need. And those with the knowledge, they can do deals in this marketplace. Those without the knowledge, they can't do deals in this marketplace because it's too complicated.
Yeah, that's a really great point, in that this is a time for some who maybe don't have the liquidity, don't have the cash, to really just sit back and sharpen their saw. In other words, gain the knowledge, invest in themselves to gain the knowledge that they need so that they are prepared for when those opportunities come up. One of the things that I don't want to step over is that there's a lot of conversation right now that's in investors' way, and that is around mortgages and the rumor changes that OSFI is going to be making, and some mortgage brokers saying it's going to happen. And that is that all of a sudden investors need to put 30% down. In other words, loan to value can't exceed 70%. That's what's starting to happen. Now, the consequences of that, if that in fact goes through, which everybody's saying that is already kind of what's happening a little bit, that aside, if that does in fact happen, it's going to even cut back further on the rental availability. So in other words, rental supply, affordable housing and affordable rental supply is going to be, really even get further depleted. So 50% of rental supply in Canada is by mom and pop investors. And so mom and pop investors have got to have the courage, the savvy, the knowledge, the understanding to step up. This is a significant opportunity. When there's chaos, when everybody's running for the hills, we have to be brave, we have to be courageous, we have to be knowledgeable and actually go the other direction. Now, there's a couple of things, JG, that has just been released with a couple of different mortgage brokers, which is very, very interesting. As you and I coach, we teach, we've been doing this for many, many years with thousands of investors. That is this: get your financial house in order so when you go to apply for a mortgage, it's all there for your mortgage broker. Well, guess what's happening right now? Technology, back to technology. It is heavy, as submitting 200, 300, 400 pages of documents to get your mortgages. Well, here's where technology is also taking it. Now, a couple of very innovative mortgage brokers, and I'm not going to use their name today because I haven't had their permission to announce it, and it's early on, and that is that they are actually getting that work done. So in other words, send us all of this information, but you're only sending them 20, 30, 40 pages of things. Then it has to be verified, but ultimately, based on what you send them, they can actually qualify you based on that pre-verification of information, and you don't take a hit on your credit in terms of a check. So this is some technology that's also happening for investors. We're going to be leading that charge when we talk with some other brokers, and we'll let our investors know what's going on.
Yeah, good point, Patrick. So I think we've covered that in detail on the Bank of Canada rate and some of the OSFI changes. So we made a little modification of that sticky. But that was a good conversation for sure.
Yeah. Hey, folks, you want to learn more about real estate investing? Go to the link below. Visit us at realestateinvestingincanada.com and get up to speed on how to invest in real estate the right way.
Next, Patrick, let's talk about the price of oil and the 5-year bond yields. Now, I think we should start with oil first because, you really want to gloat on this prediction you made. I'm going to give you that opportunity to gloat because sooner or later you were going to be right. And this might be that window of opportunity where you might be right for a little while.
I know this pisses you off when I'm right, but you know something? I said months ago, sometime in about the third quarter of 2023, we're going to see oil prices come up. As much as oil prices seem to be at a low right now, I look into 2023, I can see them doing nothing but rising. You, on the other hand, Mr. EV and all of this, you're going, no, oil's going south because everybody's going to be driving electric. Not going to happen tomorrow, but it's going to happen. So listen. When oil prices go up, they inevitably also pull back. But here's a fundamental that we need to touch on. Number one, oil prices are up and they are going to continue to increase. Now, to your point, I didn't say it was going to go to the moon by the end of 2023, but we're going to see some significant changes in oil prices. And when I look at my analysis and I look at my thesis around it, I'm seeing that happen. So why does that matter to people? Well, first off, the cost of food, the cost of fuel is going to continue to increase. That's just the reality of what happens when oil prices go up. That's nothing profound about that observation. That is, in fact, what happens. OPEC and Saudi Arabia have cut back production. Russia's cut back production. Now, here's what's interesting about this, JG. Guess why they've cut back production? China is crashing. China is crashing. So regardless of what we think of China and this boom and this kind of bravado that they've been putting out there that they're amazing and all these things are going on, what's actually happening in China, they are actually, some are saying, collapsing.
You're kidding, right?
And when you look at what happened with a lot of their real estate and how they do real estate, guess what? We're seeing the economy in China start to slow dramatically, which of course will decrease demand. So I think we'll see oil go up quite a lot. The U.S. has cut their production. They're working on reserves still. It's kind of kooky what the U.S. has done in that regard with Biden has pulled off. Just kind of nuts. So we're going to see those prices increase. And then I think we'll start to see a pullback in late 2024. It's not throw a dart like you do, JG. I'm not throwing darts. I'm putting time frames in there. And because China's economy is slowing dramatically, and I think we have to pay attention to that. So just some food for thought around oil prices and what that will eventually mean to us. So what we're going to see when those oil prices come down, we'll actually see some deflation in certain categories.
Let me just congratulate you and give you a round of applause for your incredible prediction. Because as I look at this chart, which they're going to put up on the screen here, it actually was pretty much July 1st where essentially we hit the bottom and oil has been steadily climbing since, which is officially Q3. So congratulations, Patrick. I mean, your prediction was just incredible. And now your next prediction, if I heard you right, was that you're going to see a pullback in late 2024, I think is what you just said. So
we're going to see significant, we are going to see significantly higher oil prices. There'll be some short-term, maybe a little bit of pullback here and there, but it's going to go way higher.
So what you're telling me off air before we started here, you were already bitching about the oil prices in BC being $2 a liter, which is equivalent to $8 a gallon plus. And you're telling me that you're really excited for your Tesla EV truck, which you also ordered, just so everybody's very clear that this is happening. Is that what I'm hearing?
Listen, I'm hedging my bet. That's all I can tell you.
Okay, fair enough. So oil prices. Now, what about 5-year bond yields? Let me put up on the screen the 5-year bond yields. Since 2021, it has been steadily climbing. Obviously, that was right in the heart of COVID. And essentially since now this chart here there, Patrick, that I'm showing is just, it's up to today, essentially up to today as in when we shot this, 3.942 is where the 5-year bond yield is right now. And what people need to know, especially investors, is this is how mortgage rates are determined, the fixed rates, not variable rates. Variable rates are determined by the Bank of Canada rate, overnight rate. But the 5-year bond yields, that's why we always talk about the bond yields, because this determines where the fixed rates are going, especially 5-year fixed rates. So based on this, Patrick, we see rates going up. If it keeps going in this direction, 5-year fixed rates are not going to come down anytime soon.
It doesn't look to be that way. And, certainly on the next slide, if we want to show it at some point, we started to, the reason I went back to that time frame was if you start to correlate back in 2009 when bond rates were again up in that range, you start to see where interest rates were. It's just an interesting correlation. It all is pretty, I guess it all makes sense regarding where bond is versus the 5-year fixed rates and even where variable was. So it's just a comparative and understanding what these bond yields mean to us as investors for mortgage rates, interest rates.
There's essentially been a spread, let's call it a spread between variable and 5-year rate. There's been a spread of 2.5 to 3.25, 3.5% pretty much all of the time in the last 10, 15 years. And now the spread is down to 0.09%, less than 0.1%. So it's essentially 6.40 is a variable rate and 6.49 is a 5-year rate. So, and that, the spread is definitely tightened up. Interesting to see where that's going to go, Patrick.
Yeah. Well, I think, nobody knows. Let's face it. Nobody really knows. When we look at, you and I talked about this on previous shows where, some of the frustration that everybody's experiencing with what the Bank of Canada is doing is they've raised them quickly. They've raised them a lot. And they seemingly haven't allowed for the lag that has to work through the system when they increase rates. So a lot of people are really struggling. You've got premiers of provinces like begging and pleading for the Bank of Canada. Ford came out with this whole is it a tirade? Sure. And he just trash talked the Bank of Canada. This is all on you. And of course, the federal government. And, when you look at just what the government borrowed to feed into all of the pandemic and the issues that we were dealing with, so we've got premiers in Vancouver and definitely in Ontario, not Vancouver, but premier of BC, and then Ford. And I want to say Alberta, maybe? I don't remember. Anyways, the point is this. They're all begging and pleading. Bring those rates back down where they belong. You're putting a lot of pressure on people, and it's all your fault.
But before I scrunch this sticky note, Patrick, it's important to note, and this goes back to the conversation we just had about OSFI rules. It goes back to the conversation that we had at the height of the market. These are interest rates are influencers. They have an impact on the market in the short term. That doesn't mean it's like short term as in months. It could last years. But the point is, when you invest in real estate, you're investing for 10, you're investing for 15, you're investing for 20, 30 years out. And you have to have that view. And I tell you right now, Patrick, in a number of years, interest rates will be where they'll be. They might be a lot lower than where they are. They might be a little lower than where they are. They might be exactly where they are. They might be a little. The point is that someone's going to say, I should have bought the dip. That's what investors are going to tell themselves in 1 to 3 years. They're going to say, I should have bought that dip. And I just want to caution investors and say, listen, if that's what you're going to, if you're going to tell yourself that, then take a real hard look at this market, because you should never let interest rates determine your investing decisions. They influence them. They don't determine them. And I think that's important.
Well, JG, just to share. Now, I'm not saying that this is what anybody should do. This is not advice. I have my own scenario where I have got a commercial light industrial property that I had to renew, and misery loves company. And I looked at the rates that they were offering, and they ranged in from, I want to say 8.65 or something to 9.25 for an open variable. And I looked at it, and I looked at the spread of the difference in, let's say, payment. And I went, something, I'm going to hedge my bet. And I took an open variable at 9.25%. Now, was it the right move? I have no idea, but I also know that interest rates are going to fluctuate. Will they bump up a little bit? Yeah, maybe. I don't know. Right now, I think that when we look at what's happening economically, they're going to be hard pressed to continue to raise rates. Some would argue that point. They're going to say, just look at bonds. I just don't agree. And already, and I can't remember the country where inflation is at 10%, they just dropped their interest rates 2%. So was it Greece? I don't remember.
You're not talking about Moldova or some obscure country like that, are you?
It was a little bit more major than that, but having said all of that, I'm hedging my bet. Now I've got a residential that I have to renew. It's not a big mortgage, but the point is that I'm looking at rates and I'm looking between 5.85 and 6.25, I think. I don't know if those are exact numbers for an open variable. And I'm looking at the spread and I'm going, you know something? I may just go variable. I may just stick with a 1 year open variable. Give me some flexibility, give me some options. And it's in Edmonton, and I might be just liquidating stuff in Edmonton. That's a different conversation. I want the flexibility, and the spread is not enough to kind of make me go and say lock down for 2 or 3 years, because I don't trust the Bank of Canada or our federal government. That's it. I want flexibility.
Oh, Patrick, I knew you'd bring it around to the federal government sooner or later. So
can't help it.
All right, next, folks, let's talk about unemployment rate. I think this is really important, Patrick, because, we have this pause in the rate hikes, which is great. I mean, all investors love that. And I think that you're going to see what's interesting is that the unemployment rate for Canada in general has been ticking up. Now, we're going to look at it by province as well. But the first chart I want to put up is the Canadian numbers. And you could see as of April 2023, that was kind of the low. It was at 5% there, and it stayed at 5% for many months from December 2022 to April 2023. And then it started ticking up 5.2, 5.4, 5.5. And we're about to get another one here soon. We're going to get the August numbers very, very soon. The point there, Patrick, is that now I'm not debating, Patrick. So
are you sure?
Calm down. I know this gets you all aggravated. I'm not debating whether this is right or wrong, but from the Bank of Canada's perspective, this is one of the metrics they look at, and it's been ticking up, and that's what they want to see. They want to see unemployment go up. They don't want this inflation to get baked into the economy in wages. By the way, it kind of is. We'll show a different chart on that, but they are showing that the unemployment rate is going up. And this could be partially why they decided, listen, it's working. Let's just take a pause and breathe.
Yeah, well, you and I have talked about it many times on previous shows, and the unemployment rate nationally has been far too low. 5% is not a healthy unemployment rate, and to the point of what it does is, it impacts pressure on wage growth. Employers can't find good help, so they can't grow. And then, of course, working conditions are tough because a job that should take 6 people, you've only got 4 available. So, the working conditions are not ideal. So 5% is not great. I agree with the Bank of Canada in this case that it should, in fact, increase. I would like to see it increase, and we'll talk about Alberta shortly. But when we get into that 5%, 5.5%, we're still low. That sweet spot for unemployment is just the reality of it, and history will actually, prove that out, which is that 6 to even as high as 7% is a far healthier unemployment rate because it manages costs, it manages wage growth, and then overall things can sort of level out and costs can actually come down.
So let's look at the unemployment rate by provinces now, Patrick. You can see, of course, you highlighted Alberta being Mr. Alberta. You took the liberty of highlighting it in green to show the growth happening in Alberta. I'm sure that's what you're psychologically thinking there. But essentially from worst to best, Newfoundland and Labrador being at kind of the worst unemployment rate, which is kind of normal for them. Their unemployment's always a little bit high. We don't have a historical chart here, but it'd be interesting to compare it against that. And Quebec being under 5%, same as Manitoba, and Saskatchewan just bang on 5%. I mean, you got the tightest markets there in the country versus the kind of not so tight ones. Newfoundland, Prince Edward Island, and Nova Scotia as well.
There's a couple things around unemployment. It's, when we even look at population growth, we haven't really touched on it. I'm going to use it just as an example. Of course, when we talk about not trusting the government, and I know that you kind of go, I get agitated. Well, I think that we should be able to trust the numbers. And the reality of it is around population growth, the stats can missed by 1 million people. 1 million people.
You had one job.
They missed by in terms of non-residential or non-permanent residents that came into this country. How do you miss by 1 million? So the point is what can we trust for data? And so when we even look at unemployment rates, I look at them and I have to believe them, but I have to also kind of be guarded around where I'm making decisions. Now, this is all to say this, is that when we look at the unemployment numbers, there's a part of it that they don't tell you about, which is where are those numbers? So in other words, what from a point of view of an industry, what are those jobs? How much full-time jobs? How many people are working 2 or 3 full-time jobs to pay their bills? I mean, there's a lot of things and a lot of nuances that we have to go into to unpack unemployment. So all I'm saying is this, is that this low unemployment rate, if you look at certain sectors, it's going to be far higher than in other sectors. That's what I'm saying in regards to all of this. So we just have to continue to unpack it.
And of course, it's very regional, right? Just so investors know, as you know, you should have tattooed on your forehead, please, real estate is regional. And, you know, the Canadian unemployment number means nothing to you as a real estate investor. Even the provincial number, Patrick, has a little bit more meaning, but not that much more, especially if you're a big province like Ontario, because there's so many different cities in Ontario. The question is, what's happening in your particular city? And we don't have all the cities' unemployment rate, but I encourage investors to research that and find their number for the city they actually invest in. Of course, Mr. Alberta over there has so graciously put together the numbers for Alberta, because it looks like we're pro Alberta here. But
well, like, there's a couple of things. There's
Calgary,
a couple of things, JG.
You got Calgary, you got Edmonton in here.
Yes, I did. So we're in that 6.2 range in Edmonton and in Calgary, by the way. The reason I put Alberta and I put emphasis on there is when you look at Manitoba and when you look at Saskatchewan, great provinces, but very small population in the scope of things, 1.2, 1.3 million for the whole province. So we have to consider that. Secondly, when we look at what's happening in Alberta, we're also seeing a lot of investor capital move into Calgary,
primarily because of this show. I mean,
yeah, we're driving it all. The point is, all 3 of our viewers, the point is this, is that, the shining a light on a province that is doing well gives people, some reason to do their diligence and look into where they can put their capital to work. And certainly Calgary, Lethbridge, a couple of different cities in Alberta are very strong. Now, I caution everybody, this came up in the conversation I had yesterday with the realtors when Q&A period that I did with them. Somebody asked me about Grand Prairie. Well, as you know, JG, Grand Prairie was my backyard. I owned a lot of real estate in that. My joint venture partner bought me out, and I'm happy he did. But at the end of the day, when we look at Grand Prairie, a population of 50, 60,000, I don't know what the most recent numbers are. But the point is this. I still believe Grand Prairie is an oil and gas town. It is a one-horse town for the most part. Now, somebody from Grand Prairie would argue that point, but I am suggesting that if something comes off with oil and gas, Grand Prairie gets affected. So if you're investing in Grand Prairie, you're going to get great cash flows. You're going to be buying great deals, relatively speaking, but you have to be very aware of the fact that if oil and gas does come off, and I'll even say when it comes off, Grand Prairie is going to feel it.
Another little prediction right there. Hey, another little prediction. Hey, just as a side note, Patrick, we just got to ask this question because I think we got to be transparent with people, which is, are you on the province's payroll by chance? Like, are you like a promoter for the province? I'm just checking.
Hey, well, listen, what can I tell you? When I go where it makes sense to go economically, that's it, and politically. So classic politician move there. You totally skirted the question. I think people are going to wonder now if you're on province's payroll. So I think you got to answer it. We're going to call you the ambassador from now on. Yeah, okay. Go ahead. I love Alberta. And I love Ontario too, by the way. I love Ontario. Yeah, it's just,
you love Peterborough, but Peterborough's not a good market, folks. Don't come invest in Peterborough. It's not a good market. Stay away. Yeah, unlike Patrick, I'm not promoting Peterborough. Just stay away from Peterborough. Mm-hmm. All right, next and the final conversation for today is going to be about price predictions. And that's because, Patrick, a lot of economists recently, Desjardins doing this, as a bunch of others. We're going to talk about Desjardins predictions here specifically, but a lot of economists for the various banks are starting to make predictions of what if this happens, then that might happen with the if this happens with the economy, that might happen with real estate. And they kind of got these different forecasts, and it's all very, very fascinating. I find it interesting, and I guess that's what these people are paid to do. I find it funny that they spend all their time doing this and they're wrong all of the time. In fact, I think if they were 50% right, they would be the most successful economists of all time. They're probably, quite frank, I should ask ChatGPT how often an economist is right. I think the answer is probably less than 20%. But anyways, let's just play with these charts for a second, because I got this graph showing, and this is specifically for the Toronto region home resale prices based on like what happened. So Patrick, walk us through this slide here. I got it up on slide 19. Walk us through what this means, because I think this is fascinating.
Well, I think what Desjardins did in this particular case is they kind of looked at historically what was going on, and they created what they call a base case. So July 2023, if you look at that dark green line, you start to see that given if there's some kind of a mild recession, they're kind of looking at where we are today, which is if we look at July numbers, we saw GDP into that 0.2 negative territory. So they're looking at it, and prices actually don't come that far off of where we are today in terms of pricing. But if we were to hit a 1990 style recession where there was lots of strong construction, by the way, so in terms of in regards to first there was a recession, and then there was strong construction that had already gone into it, you start to see that gray line where things are really kind of dive. But they, even in that scenario, by the way, Desjardins is saying it's not going to go to historic lows by any stretch of the imagination. The light green line, if we're into what they call an average recession, again, we come back into that 2021, 2022 numbers. I guess actually that might be even 23 numbers. So it's not that far off. You know, the reality of it is when you look at the red line, which is more where we're at today, given interest rates, of course, we have weak listings. People just are not selling, and there's not an availability of real estate, and we've got very strong population growth. This goes back to the supply demand issue. And of course, we don't see prices coming too far off at all. And as a matter of fact, we're going to see continued growth. So at the end of the day, you know, they're looking at the dotted line, which is, okay, let's go back to the 15-year average starting, you know, and they're looking at 2005, and you start to 2015, and you start to see that we're not coming off. They don't see a big pullback, which is way different than many of the conversations that we're hearing about the Canadian real estate bubble. So this, to me, doesn't show any awful, really bad scenarios, to be honest with you. I don't think we're certainly not going back to a 1990s recession. Never say never, but that certainly isn't looking in the cards over the next couple of years anyways.
Let me ask you this, Patrick. How do you think investors should look at charts like this? Because we got another one to show here, which is, you know, again, a mild to moderate recession that could have a meaningful impact on Toronto house prices. How do you look at these charts, Patrick? Because I look at this and I don't even think it's worth the ink and the paper that it's printed on. And I think that the only thing this does is sell bank accounts for the bank. I mean, the bank's economists have a marketing and sales job to do. That's pretty much it in my view, because I look at this information as pretty much useless and scaring a lot of investors because people read this, for example, in Alberta or in somewhere outside of Toronto, and then they use this kind of information to make a decision that's not great for their financial future because this chart scared the shit out of them. I think it's useless. It's my opinion.
Well, yeah, I think that's a little harsh. I don't think it's useless. I think you make a good point, though. For the average investor who isn't really educated or sophisticated in how they're looking at these charts, how they're using these charts, you're right. It's kind of a doom and gloom kind of place. I look at them as there's some benchmarks perhaps here. It's part of an overarching look at analysis. I don't put a lot of weight on it. So I look at this and I go, okay, that's good information. It's interesting to see somebody else's point of view. I don't make decisions based on a single chart. It's all part of an overarching, you know, creation of a thesis, if you will. And this is just information. It's a benchmark. So I think it's to say it's useless is a little bit harsh, but I do understand what you're saying. If you're making decisions based on this chart, that would not be a smart move. So in that regard, if you're looking for a chart to make decisions, it is useless. Having said that, if you're looking at this chart with other charts that you're looking at to get the data, get the information, it can fold into a much bigger picture that you can make decisions. Ultimately, JG, I look at it again as just information to create a thesis and base decisions on. That's it. If you want a useless chart, from my perspective, it's when they compare anything, and whether that's population growth, housing prices, I don't care what it is, and they compare it to where Canada sits in the G7. I'm going, who the hell cares what's happening anywhere else in the world, given the fact that they're different countries, different politics, different economies, different ways of doing things. Like, to me, saying we're the best in the G7, I go, okay, nice. Okay, great. Useless information.
All right, Patrick, let's wrap up the show by talking a little bit about China. You've kind of hinted towards China. I think we should round out that conversation. Sounds like you got some insider info over there, Patrick. Let's hear it. What's happening in China?
Well, listen, it's not insider information. There's a lot of that stuff out there. But here's what's really happening is, China's very guarded about the information, the data that they let out there. But there's just some things that they just can't hide. So when you're looking at what's happening in their real estate world, it's collapsing. When you start to see the actual numbers of what's going on in the US, what's happening in Europe, for example, the demand is starting to soften. Now, if you're the US, even if you're Canada, and demand softens, North America is not a productive environment. We're consumer debt driven. And if all of a sudden we quit buying or things start to slow down, that of course has an impact on China. And when you start to look at Europe slowing down, that has an impact on China. As much as Russia and China are doing business together and that's supporting what China is producing, it's actually slowing down. So we have to look at what's going on in global macro and how that impacts, a manufacturing driven environment and country like China. So if all of a sudden these things are going on and we're not buying as much, the US isn't buying as much, Europe isn't buying as much, these things are impacting, even India not buying quite as much. So real estate collapsing. There's a lot of things that are happening with China that is going to kind of ripple out, and we have to just be aware of what's happening. And that's really the extent of it. I think China has a big impact on our global economy, and we have to be watching what's going on there.
I'm really pumped for 2024. I'll tell you that right now. I think 2024 is going to be pretty incredible. A lot of the stuff that's kind of been in the pipeline, Patrick, on housing, interest rates, China, kind of all that post-COVID stuff is really going to start to kind of work its way through the pipeline. I think from a kind of a macro perspective, I think we're in the middle of that poopy pipeline right now. And I don't know when we're going to get to the end of it necessarily, but I know in 2024, we're going to be closer to the end than we will be the beginning, in my opinion. So it'll be interesting to see how this market kind of, rebounds or not just rebounds, but how the market, regurgitates after the COVID stuff.
Fundamentally, I think we all have to be optimistic with what's going on in 2024. We can get really distracted from all of the bad news out there, the confusion, the uncertainty. I really do understand all of that. But we have to look at some of the positive things that are in fact happening because opportunities are presenting themselves. And amidst all of the chaos, we have to mentally kind of set ourselves up, put ourselves into the environment, even within the REIN community, for example, understand that when you surround yourself with like-minded individuals who are looking at the economy differently, that's where opportunities can present themselves. We still are very bullish on what real estate can do when you have the education to do it. And that's what I got to say about 2024. I think there's a lot to look forward to.
Ladies and gentlemen, thank you for tuning in. Please make sure to check out the DI Vault. di-vault.ca is the website, an artificially intelligent platform that's going to help you locate deals. Incredible technology. Check that out. And also go to REINCanada.com. If you're not involved in the community, you have got to get in the community because the more knowledge you have, the less time and money you need. And that is going to be your ticket to the future. So Patrick, thanks for a great show. See you on the next episode.
Thanks, JG. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.